Good afternoon, ladies and gentlemen, and welcome to the Totally PLC interim results for the 6 months ended 30th of September 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be made available via your Investor Meet company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll. If you could respond to that, we would be most grateful. I'd now like to hand over to Lisa Barter and Wendy Lawrence of Totally PLC. Good afternoon.
Good afternoon. Thank you. Thank you. Lisa's also joining me. This is Wendy. I will start the presentation and we will do that as a double act between us. So thank you to everyone for making the time this afternoon, and I do hope that the presentation is helpful to you. And again, just to reinforce, if you've got any questions, please do submit those and we'll try and get round to answering them. So taking you through the presentation, we as the management team of Totally are really pleased with the results that we've put out to you for the first half of the year, and obviously believe that we've put in a robust performance in unprecedented times. Nobody thought that we would be delivering services through a worldwide pandemic, and we're very proud to say that we have stood on the front line of healthcare delivering services throughout that period of time and continue to do so at this point in time. The presentation will take you through the different divisions and how we've been working. And again, if you've got any questions, please submit them. So during the period, we have seen a growth in revenue, growth in earnings, growth in cash. We have continued improvement at all levels throughout the organisation. We have positive cash flow. We have no debt. And I do know that when people pore over the financial sheets, there is sometimes misinterpretation of the information that's in front of you. And I'm sure Lisa will help with that when we get onto her section. But we have positive cash flow. Our cash flow has improved during the period, and we have consistent dividend payments. We've paid 2 dividends during 2020, and in the RNS you will have seen that we've also proposed to pay a further dividend in February 2021. We've been very proactive to the responses that we've been asked to do with the NHS to help manage the pandemic, and our services have all stood up shoulder to shoulder with the NHS to make sure that we have not only continued to deliver everything that we've been delivering over the past few years, but also to assist with new initiatives that are required as part of managing coronavirus. We have had significant increases in demand for 111 services, as you can imagine. And if we cast our mind back to earlier in the year, at the end of February and at the beginning of March, when we first saw the pandemic taking a hold, almost overnight we saw a 400% increase in demand for 111 services. And as you can imagine, responding to that was challenging, but I'm very proud of the way that we've done that and the way that our staff has continued to support that service as we go forward. When I get into the details of urgent care, I'll explain a little bit more to you the way that we've changed the way that we provide the service, not only for our own internal efficiencies, but also about how we improve the services that we provide to patients. So it's not only been 111, we have deployed our clinicians into emergency departments to help with patient flow, and we've undertaken a lot of new pilots. So all in all, we've seen material changes to the way that we provide services. We've also seen changes to the way that services are procured, and as previously explained, that is why we removed forecasts from the market. We're still working through times where certainty is not provided to us, but one thing is for sure, that there isn't an appetite to rebid services. We are seeing contract renewals come through quite proactively, and we are being paid for every bit of additional work that we do. We've also been leveraging our relationships, as you can imagine, with the NHS, and through these times when you actually prove that you are robust and that you can deliver high quality services under pressure, that's when they come back to you and ask you for, to continue to support them. During the period, we've also invested on our internal systems. So as you can imagine, when you're responding to a pandemic, you also have a responsibility to keep your staff safe. So whilst we were continuing to deliver services, we were also responding to the guidance to make sure that any of our staff that had an underlying health condition or were required to shield or to take on new ways of keeping themselves safe, we used our own internal systems and our health coaches to ensure that they supported our staff one-to-one, so that they knew the best way of keeping themselves safe during that. We've upgraded our telephony system. It was always in our plans to do so, but with the increased demand during the period, we replaced our telephony system, and where possible, we also moved our face-to-face services to video consultations or telephony consultations. So all in all, we've been very, very busy, but everything that we've done is added to the robustness of the organisation going forward. So if I then move on to a little bit more detail about urgent care, and I'll just take this opportunity to remind you that urgent care accounts for about 96% of our revenues. So when we talk about urgent care as the business, it is the vast majority of what we do right now. It comprises of the Vocare and Greenbrook. And again, just as a reminder, we provide the whole pathway of urgent care services. I've already talked about the increase in demand in 111 and the challenges that brought. But one of the things that put us in good stead very early on during the pandemic was we made changes to the way that we provided our 111 service. So pre-pandemic, the way it worked across our contracts in 111, they were all managed individually. So we have call centres across the country, and once the 111 call had been answered, what used to happen was the patients that needed to speak to a clinician were then put into a queue to speak to clinicians in that 111 service. It's not the most efficient way of providing services, and very early on we saw that we were getting different queue times and different demand increases depending on how virulent the virus was in different parts of the country. So we worked with the NHS England digital team and our own digital team to bring together a new innovation, and we've implemented an integrated national clinical assessment service. So what that means is the CAS operates a single queue. So from early on in the pandemic, the way that we've run our 111 service is as soon as the call is answered and it is deemed necessary for that caller to speak to a clinician, you're added to one single queue. So your call is answered in terms of the acuity of the presentation that you're making. So it enabled us to ensure that the patients with the greatest clinical need were actually expedited and spoken to by one of our clinicians based across the country. This was reviewed by NHS England and has now been accepted as a gold standard, and 111 providers have been asked to aspire to have that system integrated, obviously in their own 111 services. We're ahead of the game because we've got it. We designed it and we piloted it and implemented it. And what that's meant for Totally is that during recent months, other 111 providers, and for example, the ambulance service that operates in the northeast of England, where they provide the 111 service, they continue to answer the 111 calls, but anyone that requires to speak to a clinician now comes through into our CAS. So we get paid for that additional work. Now, it's fair to say, because of the amount of uncertainty around the pandemic, no one is issuing contracts for long periods of time, but we're picking up contracts that are for 6-8 months, and it's all helping build that base. And the big review that's underway at the moment with NHS England is what the future of 111 should look like, and I'm sure a lot of you have read up on the probabilities of implementing a new system. It's been referred to as Think 111. We're not sure that is what it's going to be called, but it's very similar to a system that works in Scandinavia, where whatever your health needs are, you get in through a one number telephony. So whether you want to make an appointment with your GP, with an NHS dentist or other parts of the NHS, you would come through that system. And again, we've been piloting that with the NHS, and we've been using our contract down in Cornwall to pilot that, and the results of that are currently being considered by NHS England, and very much we see ourselves as part of that service going forward. So not only have we been involved operationally, but we've also been involved strategically by working with the NHS, and you will see on the presentation a number of other examples of where we have been doing specific work for managing coronavirus. And before I move off urgent care, I guess the last point to make to you is that every piece of work that we have done that is additional, or any capacity that we have managed that is above and beyond our contracts, we have been paid for. The NHS has always been a reliable payer, and certainly during the pandemic they have ensured that cash flow isn't a problem for us as we are working with them proactively. So we remain part of a very, very important service to the NHS, and one which we believe is going to become more strategically important as we go forward and get used to living with coronavirus as part of our daily life, because it's clear that it isn't going to disappear anytime soon, and it's a case of how do we live with that. So I'll move on from urgent care now and go on to the next division within the group, which is planned care. This is the part of the organisation that delivers outpatient services, physiotherapy, podiatry. We do a lot of work in prisons, as you know, and providing clinics from GP surgeries. This division was impacted during the first lockdown, and if you can cast your mind back, the NHS at that time was completely overwhelmed by coronavirus patients, and so all elective care was stopped for a period of time, and this did impact on planned care, and we saw a halt put on the services that we were provided. We weren't allowed to go into prisons. As you can imagine, coronavirus in those environments is very difficult to manage. So for a period of time, predominantly from the middle of April through to the end of May, beginning of June, we were doing very little in terms of service delivery for planned care. Where we could move face-to-face consultations onto video consultations, we did. We harnessed new technology, and it is fair to say that we were doing a fair percentage of the work that way, but a lot of planned care came to a halt. So we did furlough some staff. All of those staff are now back at work, and I'm very pleased to say that since August, services have been remobilised, and we're currently in planned care working at about 85% of the previous capacity that we saw in planned care. It has not been impacted by the second wave, and it has not been impacted by the second lockdown. We are beginning to see tenders reappear in this part of the business. There is recently a dermatology tender actually reappeared, so we will be looking at ways of how we not only remobilise service, but also how we grow this division going forward. Lisa will cover a little bit more details of the financials when we get into that section. So if I can now move over onto our insourcing division, and just to remind you, this was the startup company that we launched back in October 2019. And this is where we go into hospitals and generally work over the weekend using hospitals' facilities, using their equipment, and targeting to reduce waiting lists. We take in staff, we take in consultants, nurses, operating theatre teams to do that work. And again, it was doing very well from when it was started up, and it was hitting its targets. And then again, it was impacted by the stop on elective care, and purely to allow hospitals to manage coronavirus. So again, during April and May, insourcing was paused. We remobilised services in insourcing back in June, and we started again in the Republic of Ireland. The Republic of Ireland took a slightly different stance to the way that it managed coronavirus, and they did keep a couple of hospitals COVID-free. So during June, we worked every day during June, so not only weekends, but every day during June, providing endoscopy services, mainly focusing on colonoscopy services and diagnostics around around that service, and we have continued to work back in the Republic of Ireland every weekend since then. We've also resumed work in Northern Ireland, and we are working at hospitals across England. At the moment, we continue to work in Durham and Darlington and Burnley, and we have just remobilised a contract in Scotland. So again, these services have not been impacted by the lockdown recently. The Irish lockdown didn't impact on these services. The order book for this division is increasing way beyond whatever we thought it would do, and that's because of the stop of elective care that was seen during the first wave, and the fact that waiting lists have increased during that period. We know that in England there was an additional 4 million people put onto waiting lists. We haven't got similar figures for the rest of the UK, but the inquiries that are coming in to our insourcing division and the pipeline that's now coming our way is beyond what we thought our predictions would be. So we are very confident that once hospitals get over the second wave of coronavirus and that they have confidence that they can push ahead with elective care at pace, that we will see this division start to grow quicker and be mobilising more contracts. So if I may now, if I hand over to Lisa, who can take us through some of the financial headlines.
Thanks, Wendy. So headline here, excellent performance. We are really pleased with our performance in the first half of the year, financially and operationally. Is a really positive position, we believe, given the challenging circumstances for so many business, and all our key metrics are moving in the right direction. And this is reflective of our continuing hard work during this period. So we're looking at 10% growth in revenue compared to the same period last year. We've delivered a profit before tax. As Wendy mentioned, we're continuing to pay dividends. Our interim dividend payment is anticipated in February next year. And cash is strong at 12.3 million, and we remain debt-free. Now, debt-free, we mean no borrowings, no loans, no overdrafts. Some of you might recall that the lease liabilities were brought onto the balance sheet last year. It's a new accounting standard, IFRS 16, for those of you that are interested. And this mostly relates to property leases. And this liability at the end of September is around 3.5 million. We are proud of our position. There has been a lot of positive movement on the balance sheet with regard to clearing up legacy balances that pertain to the acquisitions. Suppliers, when they invoice us, are paid promptly, and our payment processing policy is publicly available. And I can reassure shareholders and potential investors that we protect the business with prudent accruals against things like medical malpractice, the risk of medical malpractice, and any other items that don't present an immediate or likely cash risk to the business. And I'm keen to clarify this, particularly as it's easy to make incorrect assumptions around the balance sheet content. We don't put all the detail of the balance sheet out there for obvious reasons. And as a consequence, it can be easy to not draw the right conclusions. The board are always aware of our balance sheet position, and we remain comfortable with it. If I move on to the profit and loss account, so a nice clean P&L for this period with no exceptional costs. Obviously, the period last year included acquisition costs, acquisition of Greenbrook. The margin has improved. I mentioned previously, those that were on the last presentation, that we had non-recurrent income last year, and thus the margin on the face of it's 19% is an underlying margin of 17%. In H1, we're at 18.8%. And with usual pressure on the second half of the year, which is caused by seasonality. Now that remains uncertain, given that we're in a lockdown at the moment. Normally winter brings additional costs in that we have to put more staff on, demand is higher. So for the second half of the year, likely to be more like 16% gross margin. So for the full year, I'm expecting to maintain that margin of 17%. Our EBITDA margin outlook for the full year is around 3.5%. The furlough impact during the period is not significant. the vast majority of our workforce were able to continue to work. And actually, as Wendy said, we recruited during that time as well. We have Greenbrook now fully consolidated into the group, and you can see that admin costs have been well controlled, and it reflects the success of that integration. Planned care revenue is at 50% compared to last year. Activity is coming back now. It's a higher margin than urgent care, and new tenders are slowly coming through. Insourcing, again, higher margin business, that delivered at about 30 to 35%. It delivered £1 million of revenue in the first half of the year, and that's pretty much what it delivered last year. It wasn't a full year last year, and we were ramping up the business, and we did say previously, we had a run rate in April 20 booked in of 5.4 million annualised, so 450,000 for the period of April. That was cancelled, and we have seen revenue picking up month by month. We're now at 3.5 million annualised run rate, and we are obviously all aware of the fact that when we first did our business plan for this business, the waiting list demand was nothing like it is now. So that's the opportunity has clearly significantly increased. It's a business that we can mobilise very quickly. It's not heavy with CapEx. It requires no working capital. And as such, there is still significant opportunity. And that will, of course, change the mix in terms of our margins. Just moving on to cash flow, clearly cash generative now. All our COVID-related activity has been paid, and our debtor management remains excellent, with some improvement on the historic Greenbrook collection. Underlying cash, I will point out, is 2 million lighter. Payments to HMRC by many businesses were deferred in Q1, and as such, that is reflected in our cash balance, the benefit of that. As you will all know, we don't have guidance out at the moment, and we're mindful that we need to keep the market informed. So on that note, I'll hand back to Wendy, who will provide some information as to what we're looking to do with the cash and how we plan to enhance our earnings going forward.
Okay, thanks, Lisa. So just in summary, really, because there's a lot of information there to take in. To clarify for everybody, all of our divisions continue to work through the current lockdown. None of them are impacted, and I know there has been questions raised about that. All of our services have been adapted to reflect the new COVID-19 safety measures. So where we have to have social distancing or PPE or any other services that we need to change have been changed, and that's now part of our business as usual. You've heard us talk about the waiting list growing and the opportunities that brings, and the resilience now across our finances is much improved from where we were previously, and I hope that Lisa's answered the questions of I know that there have been some around in terms of how the finances are presented. We will carry on paying our dividend, and again we've kept that dividend at a level that we are comfortable with. And again, I know that there have been some queries out there about, should we stick with that as a policy, and I'm absolutely clear that if you ask 20 people you get 20 different opinions, but it is the intention of the board to continue to pay dividend. We have not moved to progressive dividend because as soon as you start increasing that, there is an expectation that you'll increase and increase. And until we are able to put guidance back in the market, until we know that, we know exactly where the insourcing division is going and everything else, we just want to remain prudent. So there aren't many businesses paying dividends right now. We're proud of the fact that we're proud of the fact of our cash position. And we will continue to support investors in that way and hope that that's received in the intention that it's made. So this for us is the new business as usual. So where are we and what are we looking to do in the future? We are seeing some tendering opportunities come back. At this point in time, it's only planned care, but that in itself is significant. We are seeing opportunities for growth in revenue in urgent care, but they are very, very short term. So as soon as tenders come out, we obviously will be looking at them, and if it's something that would add to our portfolio, we will be going for those. We're not looking at any game-changing acquisitions at the moment, so we do not foresee going back to the market to raise any money. We are very content with the businesses that we've got and our opportunity to grow organically. However, we will be looking at any opportunities that come our way for small acquisitions, and there are various things that are being discussed internally at the moment. So we're looking at technology and the use of technology. I've already gone over the fact that we've, reduced our face-to-face consultations wherever we can. We have moved on to video consultations where we can, and I'm sure there is some more work to be done in that area, and we will be looking at those. And is there any tech companies that we could acquire to bring in, or actually are there individuals with tech experience that would bolt onto us? We're also being approached by companies that haven't fared so well during the pandemic, and I think it's fair to say that we've done well because of the breadth and the diversity of our services, but those that haven't got that benefit have struggled somewhat. So if there are opportunities to take over contracts that would be earnings enhancing for us, we would be looking at those. And indeed, if there are any companies that we thought would enhance our ability and reputation in the market, we will be looking. We're also looking at the what we should do for new models of care, for things that have arisen out of the pandemic. And I'm sure a lot of you have been reading the press around the impacts on our mental health and well-being during lockdowns. And I think all of us as individuals will have struggled in our own way, depending on how you're impacted. And mental health, whilst we do provide mental health services, of course, via our 111, it isn't a specialist area that we've been looking at. So again, we will be reviewing whether that is something that we should be looking at within Totally. Should we be looking at services that focus on wellness and the reducing ill health? And again, if you read in the press, you will have seen that a lot of people, by getting themselves fitter and more healthy during the period, have managed to reverse some underlying conditions such as diabetes. And again, we've got all those expertise in-house, so we will be looking at any opportunity that arises from that. So we're not content just to sit back and sit on recurrent revenues. That isn't the kind of business that we are. We are looking at opportunity. We will look at how we grow in the new world. But I think the important thing to say is we do have a good sound base of revenues. We will be looking to how we grow those. We will take opportunities via tenders as they arise. And we will be looking at how we use that cash wisely going forward. So I hope that's been helpful, and that's really the end of the presentation. So thank you very much.
That's brilliant. Thank you very much indeed, Wendy, and thank you very much indeed, Lisa. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review investor questions already submitted, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. And before I hand back to Lisa and Wendy, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. And we would very much encourage you to do so. Wendy, Lisa, obviously investors had the ability to pre-submit questions. We received 3 questions, which I'd like, if okay, to start off the Q&A. Before asking you to go to the Q&A tab to read out the questions that have come in during the meeting itself. The first question was, why are contract wins bundled together before news is released? It creates a void of news for weeks.
Okay, yes, I saw that question. There are a couple of things that influence when we announce news. So first of all, if it is material, then obviously we are obligated by the market to announce as soon as we we become aware of that, and of course we will do that. We're in a very unusual position that we are the only healthcare company that the NHS works with in a big way, that are required to announce news. And sometimes we do have difficulty with commissioners who don't want contracts announced. They are accused many times of privatising the NHS, and so we have to work very hard with not all commissioners, but some commissioners, to agree what we can say and how they want us to say it. So where contracts tend to be smaller, we do tend to bundle. We don't leave them over a long period of time, and if there aren't a couple to be put together, we will announce them singularly. But we will comply with AIM. At this moment in time, I have to say it is one of the trickier areas of the business, because all back office function of the NHS has been redirected and refocused onto other parts. So to be honest, the NHS would be quite happy just for us to run with contracts and not to get signatures on pieces of paper. So there is a great effort from my staff to actually get contract renewals over the line, but we are continually reassured that there is no appetite to move work away from providers that are providing a good service. So I will take on board the question, and if we can release things quicker, we will. But as I say, it isn't just a matter of us deciding what and when we do it. So I do hope that helps a little bit with explaining.
Certainly does. Thank you very much. The second question: has the insourcing division been impacted by the Irish lockdown and the second UK lockdown? Are THC still gaining contracts at both private and NHS hospitals?
I think I've answered the majority of that question during the presentation, in the fact that they have not been impacted via the second lockdown. But in relation to the second part of the question, THC works with healthcare providers. We haven't got any contracts with private hospitals. So all of the hospitals that we are working with are part of the national healthcare system, both in England as part of the NHS, the Scottish Health Board, and then the different health boards in the Republic of Ireland and Northern Ireland. So, but no, they haven't been impacted by the second lockdown.
Thanks very much indeed, Wendy. And the final question: are there plans to expand the business in ways that do not depend on NHS contracts?
Yeah, I mean, again, in the presentation, I think I've talked about that a little bit in terms of what our offerings could be, and looking at mental health and different opportunities coming forward. And it is quite interesting that some of the companies that we've spoken to in the past and haven't moved forward with for a variety of reasons, we are beginning talks with them again. And there are pros and cons of working with the NHS, but I do have to say, I think the pros outweigh the cons in terms of you do get good longevity on revenues, and they are an excellent payer. So, we will never look proactively to move away, but where opportunity presents itself to do different work, then yes, of course we will.
Thank you, Wendy. Well, that concludes the pre-submitted questions. If I could ask you just to click on the Q&A tab on your screen as well, you'll see the investor questions present themselves. Perhaps if I could ask you to feel free to read out who the question is from, along with the content of the question, and give your response where it's appropriate, and I'll then pick up with you after the end.
Okay, thank you very much. So if I take on this, then there's a couple on here that I'll hand over to Lisa. So the first question is from John W.S. and is the likelihood of vaccine coming on stream a positive for trading outlook? Yes, when a vaccine or vaccines become available, we have been working with the NHS. We will be part of that vaccination programme, so we will be part of the process for giving vaccine. So whatever that looks like and whatever the logistics turn out to be, then we do expect to be part of that, and our clinicians will be there administering vaccine. We haven't got a timescale for that yet, and as you're all aware, it's a very much a fast moving discussion that's underway at the moment. I think it's when you read the press at the moment, it's very optimistic. There are a few more hurdles to go, but yes, it will be positive for us. And just to reinforce, anything that we do additional, we are paid for. So yes, the vaccine will be part of that as well. We have a question then from Andrew N. that says, you say there is no debt, so could you explain the trade and other payables line in the current liabilities of 26,839,000? Lisa, I'm going to hand over to you. I think you've already explained it in the presentation, but I think it's probably worth going over that again.
Yes, thank you. Yes, I have tried to answer it. I think it's difficult without giving all of the detail of the balances in there, but I go back to the fact that it's, and I've seen this, I've got previous experience in healthcare, and when I say in healthcare, I mean of a very, very similar business providing this very specific type of healthcare. And we are a business that, we're not particularly heavy on assets. It's not capital intensive. We rent properties, which obviously now have come onto the balance sheet. We don't invest a lot in tangible fixed assets and PPE. I used to know that as property, plant and equipment, but obviously it has other connotations now. A lot of our CapEx is reimbursed by the NHS. So when we start our contracts, we get paid for that. So we don't necessarily recognise that in the same way. So we do, we're very prudent against risks to the business, as I said, against medical malpractice, anything like that. It's not necessarily an imminent risk or ever a risk that's going to crystallise. So we do have provisions against that. And the other thing to mention is, of course, with dilapidations. We have dilapidation provisions again in there, and some deferral of revenue per contracts. So it's the nature of the business as far as I'm concerned. It's not something that worries me. I know it gets attention, and I think for every person that says, are you worried about your balance sheet? I have a couple that say, congratulations on a good balance sheet. So it's really, it is what it is, I think, and the board are very comfortable with it, and we review it. So I don't think there's much more I can say at this time to give detail of what 27 million is broken up.
Yeah, but let's just be clear, it is not debt.
Exactly.
And I think, it is part of the business. And but again, because I know there is so much interest in that, we will do our best to ensure that you get more visibility on that as we move forward. But yeah, please be assured, as Lisa said, that we spent the last 2 days talking to institutions, and not one of those institutions has queried that line.
Mm-hmm. I think perhaps it's a question of making it clear what is not, an imminent cash outlay. We're talking about provisions against potential, certainly not real risk. So I would not necessarily regard that as very clear working capital. I'll leave it there.
Okay, so next question, Peter D. Given no new NHS contracts to be bid for, the only contract rollovers, how do you plan to grow revenues? Again, I think I've covered that in the presentation, but we are seeing NHS contracts now coming up for tender. They've started to come out again in planned care, and we expect tenders to resume once we know where we are with managing the pandemic and what the service requirements are going forward. And I would refer you back to my previous statement about the fact of the changing presence of NHS 111 and the fact that we are a key provider of that. So we're not going to sit back on our laurels and just look to grow revenues, slowly and creepy. That's not the business that we are. The revenues that are in there obviously are a great platform for us to grow for, but we are actively looking at where else we go. So don't expect us just to sit back, because that isn't what we're going to do. The next question is from John W.S. Are you looking to gain long-term contracts in relation to 111? The simple answer is, of course. We've got long-term contracts with 111, and we wouldn't move away from that position. And again, I hope during the presentation, as I've explained to you, the changes we've made on the clinical assessment service, we're a gold standard provider of 111. So, we are very well positioned for whatever that turns out to be in the future. And it's certainly a service that's growing and not one that's retracting. So again, I hope that you've picked that up during the presentation, but yes, of course, we will be looking for long-term contracts. Another question from John WS, the continuing health effects of COVID is uncertain. Do you see opportunities for totally ongoing? Yes, and again, throughout the presentation, you've heard Lisa and I both say that, you know, this is now a new normal way of working for us. Coronavirus isn't suddenly going to disappear, and every one of us has got to learn how to live with coronavirus. You know, a vaccine isn't a golden bullet. It's part of the toolkit to actually manage coronavirus. So I hope during the presentation and the examples that I've given you, you've seen that not only have we been responsive to need, but we've also been proactive to ensure that we can influence the way that services are provided. So, you know, I don't want to be a chief executive that stands up and says that, you know, we have profiteered on the back of a pandemic. That's not anything that any organisation would want to do. But what I will stand up very proudly and say is that we are an organisation that has stood on the front line. We have responded to the demand that's been put against us and proactively influenced how those services are going to be provided in the future. And, you know, my staff throughout of this have been at work every day. We've helped them to understand how to manage their own health, but I'm very proud, don't want to tempt fate or anything, but, you know, we haven't lost any members of staff during the pandemic. We've had a few that have been very, very poorly, and we've helped them through that. But again, the feedback from the staff is that not only have we been, you know, very positive in the way we've been responding with the NHS, but we've also been acting as a good employer. So, you know, they have gone above and beyond and will continue to go above and beyond. And, you know, we're very proud of that wherever we sit in the business. Another question from Chris B. I'm reading these as I go through, so please bear with me. Excellent performance in challenging circumstances. Well done to all. What's the current view with regards to acquisitions? Can you comment on the pipeline and if Totally are currently looking at potential acquisitions? And sorry if this has been covered in the opening part of the presentation because you missed it. Chris, I didn't cover it in the opening part, but I did cover it in the latter part of the presentation. So I do think I've answered that. But whilst we're not looking at any game-changing acquisitions and I'm not looking at raising money, we will remain acquisitive, and when opportunities present themselves, we will be looking at how we can move forward. So next question, Andrew N. With the current low market cap and the good cash position, is the business susceptible to a takeover by a bigger player? I think businesses are always susceptible, and I mean, I think Totally's been in that position for a long time, but if we were in any talks or any negotiations as an AIM listed company, we would need to declare that. So there is nothing that's ongoing. You know, quite the reverse. We're actually talking to organisations that we may take over, and we're in the position now where we can afford to be choosy. So I certainly wouldn't be taking businesses in that were failing businesses, but if it was an opportunity for us, obviously we'd have that conversation. Alex S. Hi, great presentation, great performance in tricky conditions. On the M&A front, just wondered what firepower do you have for acquisitions without having to raise any fresh equity? I think I've answered it. We're not looking to go out and raise money. We haven't got any big acquisitions that we're actually looking at, but obviously we will be looking for opportunities. Peter D, have the Care Quality Commission ratings changed in the period? No, the Care Quality Commission, they, like a lot of other businesses, suspended some of their routine work, but they have resumed inspections now. If they do change, I'll let you know. But again, our own clinical quality director, who sits alongside Lisa and I, and the influences that she brings along with the medical leaders in our organisation, continue to ensure that the changes that we've made during the period all stack up to scrutiny. So you know, you can never say never, and you know, if we are inspected, then we'll work with whatever the Care Quality Commission says. But the simple answer is no, they haven't changed during the period. Are there any plans to return government furlough grants, especially in the light of plans to continue paying dividends? That's from Jonathan B. Sorry, I didn't say your name. No, there isn't. And the reason that we took the opportunity to use the furlough scheme was back in the original pandemic, we really didn't know how long it was going to go on for, and we really didn't know how it was going to be impacted. We never had many staff on furlough, and we brought them back to work as soon as possible. So we didn't have staff that were sitting on the furlough scheme throughout the whole period, but we did have some staff that were furloughed. But no, there isn't that plan. Owen B, I love this question. Why do you think the share price seems weak considering your results are decent? This is where I wished it was two-way and you could tell me why the share price seems weak. I don't know the answer to that question. It's quite frustrating from our point of view when we seem to do everything that is expected of us. We surpass our own internal expectations. We get feedback from the NHS that is above and beyond any feedback that a business would want from their main commissioner. Why is the share price low? I don't know the answer to that. I genuinely don't. But from our perspective, we will continue to do what we do. We don't just provide services based on what the share price is, and hopefully over time the share price will respond in a way that we'd all want it to do. I share your frustrations, so let's hope, because we believe these results are excellent, and there aren't many companies that would be sitting in front of you today talking about how positive these things are. So, Owen, I'm sorry I can't answer your question, but that's me being very honest. Lisa, there's one here for you from Nitin P. Gross margin fell year on year, so there was a shortfall. I'll leave you to read out the question. We could pick those off as we go through.
Yeah, I will do. Yeah, thanks, Nitin P. So your question was your gross margin fell 130%, so year on year. So there's a shortfall of 630,000 in operating profit. So I'll take each part of the question actually as I say it, because I think I clarified that in the presentation that underlying our last year's the period, so H1 last year, we had some non-recurrent income there. And so underlying it was 17%, and I had that in our annual report as well. So is it actually underlying is an improvement, although granted on the face of it, if you just goes back to the point about the amount of detail we're able to give, on the face of it, yes, it does look like a decline, but it's not underlying, it's an improvement in gross margin. So our cash position swing is driven by better working capital, allowing us to report gross profit. So one, why did gross margin fall? I think I've just answered that one in actually underlying it didn't, it improved. Two, has the benefit of your working capital improvement now fully worked through? Yes, it has, in terms of the core business, the underlying business performance, the improvements we've made in our working capital management post acquisitions. But I did also highlight the fact that we have deferred some of our HMRC payments. They will all have been paid by the end of the year, so that will reverse, and that is about 2 to 2.5 million. Three, what are you doing to improve margins in an essentially fixed cost business? Thanks. So I would probably argue it's not entirely, or not at best, essentially a fixed cost business. There's lots of opportunities for us to improve our operating margin through operational efficiencies, which we've already delivered a vast amount of those, particularly in terms of rota management. There's always some way to go there. We look at the staff that we use, so where we might use GPs, we put in a lower cost staff, so where we are able to use emergency nurse practitioners, for example, instead of GPs, then we will do. We've got a programme of work at the moment where we're training our own emergency nurse practitioners in-house. Agency usage, trying not to use agency when peak time comes and we have to put a lot of staff on. sometimes we have to use agency staff. We always monitor our agency usage. Procurement initiatives. We're currently at the tail end of renegotiating agency contracts with Greenbrook, getting those onto standard terms. And of course, the overhead consolidation. We are always mindful of our admin costs. We're now at the point where we can really leverage the scale that we have, and softer things using better business intelligence. We've actually invested not only in the telephony system, but also in better dashboards, better performance management, and better use of management information. So, there's absolutely a lot of good work that we're doing. There's still some work we can do. There's still opportunity. So hopefully that's a reasonably full answer. And Nitin.
Thanks, Lisa. Thank you. So moving on through the questions, the next question is from Abby R. Would you consider share buybacks? We've considered share buybacks in the past, and our brokers are very, very clear that you should not just do share buybacks to support your share price. You should do share buybacks when there is a massive all round benefit to everybody. So at this point in time, no, it isn't something that the board is looking at. Will we ever look at it? Maybe, but as of right now, no, it isn't something that we're considering. And thanks to Andrew N, who has just said that during the presentation the share price went up. So there you go. How do you address your share price? So Mark R, do you see THC, so Totally Healthcare, as a takeover target, and have you had any inquiry or interest shown? That's Mark in Taunton. Simply no, we haven't had any interest shown whatsoever. There are other insourcing companies out there, but the way that we differentiate ourselves in the market is that high quality patient care delivery. And obviously THC have got the benefit of leveraging off the platform that we've got in Totally. So, you've heard, anybody who's listened to me has heard me harp on about high quality care and the requirements of that. So we haven't had any inquiries. Do I see it as a takeover target? I don't think I do in itself. And any new market entrants have got to hit the ground running with high quality care. So obviously we're ahead of them in that. So no, for now on, we'll keep THC as it is, and time will tell. Jonathan B, if you were to raise funds for a major acquisition in the future, would you consider including a retail offering, for example, via primary bid? We would never say no to offering retail and institution. I mean, as I've said during the presentation, we haven't got any plans for major acquisitions. We're not looking to go out to the market to raise funds right now. But if that changes, then why wouldn't we consider that? And I do have to say, everything that's raised with us, we do make notes of, and so I will note that, but there are no plans for that at the moment. You have a number, Nigel B, you have a number of different operating companies under Totally Health. Are there any plans to rebrand under one name? We don't have a number of different operating companies under Totally Health. We have a number of operating companies under Totally. Totally Health was the original part of the business when I started this way back now with Bob. Totally Health was the one business in there, and then we've grown from that. When we started to just focus purely on healthcare. And again, I know there was some speculation out there that we're involved in the Jewish news and Jewish media agencies. No, we're not. That was something, I think, 18 years ago. I think that appeared. So please be clear, we're a healthcare company only. But in terms of the other question, I guess, about rebranding. Branding is something that we are looking at internally, because we have been acquisitive. We have acquired a number of companies, and they are now working in 3 distinct divisions. So branding will be something that we will be looking at. For those of you that work in business, you also know that that's quite a big exercise. So it's not something we were going to get heavily into during the pandemic, but it is certainly on the agenda. And from Desh, hi Desh, going forward, are there going to be quarterly presentations? It's something that Lisa and I have talked about, and actually we've discussed with Investor Meet Company. So it does seem to be a very good platform for engaging with the retail side of our investors. So if the feedback, and again, going back to, I'm sure you'll be reminded in a minute, but if the feedback from this kind of forum is positive, then yes, of course. I mean, we want this company to be as successful as it can. I want the share price going through the roof just as much as you guys do. Most of all, I want to make sure that we are robust and we're performing in line with what we said, which I think is what we're doing.
Perfect. Wendy, I think, and Lisa, looking through the Q&A tab, I think you've absolutely addressed every question that has been sent in by investors. So thank you very much indeed. Perhaps ahead of me boring investors and telling them how to provide feedback, if I could just ask you to wrap up, Wendy, and then, as I say, they'll be automatically redirected to give you that direct feedback.
Okay. I guess finally, thank you to everybody who's taken the time to listen. It is really important that we work with everybody so that you understand our business. It's not the most easily understandable business model, but I am very proud to sit here as Chief Executive and present to you what I consider to be a really robust set of results during unprecedented times. As I say, none of us have worked through a pandemic before, and I hope we don't have to in the future. But what we've actually proven is that if we do have to, then Totally, as a healthcare provider, is absolutely ready to do that challenge. We will grow, we will continue to develop, and finally, yeah, just thank you very much for your support. It is very, very, very welcomed.
That's very kind of you. Thank you very much indeed, Wendy. And thank you for updating investors as part of your results roadshow. That I'm sure that's greatly appreciated. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunities to provide feedback. If you access this meeting directly from the website, the feedback page will appear. If you accessed it via the link sent you by email, you'll be simply asked to log in. It takes 30 seconds or so, and then for you to provide your feedback. And as the company have already highlighted, it's incredibly important. Therefore, on behalf of the management team at Totally PLC, we'd like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good afternoon to you all.